Every rookie landlord believes the lie that you need massive personal wealth and a perfect credit score to take out multiple rental property loans under a business. The truth? The pros play a different game entirely, and today you're about to see the playbook that don't teach in real estate school. Secret number one, the elite property investors don't use one company, they build a portfolio of LLCs. Here's the hack. Instead of stacking all properties into a single business, they form a distinct LLC for each property. Why? It's about insulation. If one property faces a lawsuit or a foreclosure, the others remain untouched. The impact? According to recent legal analyses, this structure can reduce cross-liability risk by up to 80%. Picture the Smithson Group, which grew from 3 to 18 properties in 4 years, all protected in separate LLCs. When a tenant slip and fall lawsuit hit one address, the rest of their portfolio and their personal assets stayed fully shielded. It's high-level risk management while keeping lenders confident. Secret 2. Savvy founders unlock creative loan layering with commercial lenders, not just traditional banks. Here's how the best do it. They build relationships with regional banks and credit unions, which often have more flexible lending criteria than the big names. A survey of top-performing property firms shows that 62% use these local institutions to structure blanket loans, a single loan that covers multiple properties under a business entity. This move doesn't just simplify paperwork, it also enables rapid scaling. Consider Apex Holdings. By securing a $2.5 million blanket loan through a regional lender, they acquired 5 duplexes in one deal without ever touching their personal credit file. It's a financing strategy that accelerates growth, especially in competitive markets. Secret 3. The real insiders supercharge their approvals with cash flow stacking, not W-2 income. Here's what winning CEOs know. Lenders for business loans care more about your property's projected net operating income than about your salary. Top players like Urban Nest Ventures package robust rental histories, signed leases, and conservative expense forecasts to demonstrate profitability. In fact, recent data shows that showing a 1.25x debt service coverage ratio, meaning net rents are 25% higher than total loan payments, boosts loan approval odds by over 40%. Urban Nest leveraged 2 years of rent rolls and expense statements to secure 3 new loans, despite the owner having left his corporate job months earlier. For business-based property loans, cash flow is king. Imagine your business not as a single fortress, but as a network of independent strongholds, each property guarded by its own moat, each with its own supply lines. The rookie builds a castle out of sand, one legal entity, one funding source, one paper trail. The pro constructs a city of stone where even if one tower falls, the others stand strong. Funding comes from many wells, each tapped strategically. The business's strength isn't in one massive wall, but in the separation, flexibility, and resilience of its design. Each LLC is a locked safe. Each lender relationship is another open door. When trouble comes knocking, only one room is exposed, while the rest of the empire keeps humming, untouched, and stable. Now let's shock the system with one final staggering statistic. Companies that structure their rental portfolios with multiple LLCs and use regional lenders for loan stacking grow their portfolios 2.5 times faster than those following the old-school single-entity model. That's not theory, that's market data. In fact, in the last 5 years, over 70% of the fastest-growing rental empires in the U.S. use this exact playbook. This isn't just protection, it's acceleration, turning risk management into rocket fuel for expansion. Here's what the smartest founders are doing. They're not waiting for traditional gatekeepers to bless their next move. They're actively building a web of protection around each asset, leveraging those legal silos to keep their downside limited and their upside huge. They're not fixated on personal income or credit scores. They're obsessed with demonstrating property-level cash flow and operational discipline, because that's what wins loans under a business every time. The winning companies don't get stuck in gridlock with big banks. They're forming partnerships with agile, local lenders who understand the value of a well-structured business and the real cash flow numbers on the ground. They're using blanket loans to buy in bulk, and they're stacking entities and loans to create a scalable, defensible empire. If you're still running all your rentals through your personal name or stacking properties inside one business, you're not just missing out, you're leaving yourself vulnerable and slowing your growth. The market is moving fast, and those who master entity structuring and creative financing aren't just surviving, they're dominating. So what's stopping your business from joining them? The old playbook is obsolete. The secrets are out. The only question left, will you start building your portfolio the way the outliers do, or keep following the crowd? Because in today's market, speed, protection, and scale go to the operators who know how to use business structures and creative lending to their full advantage. The next rental empire won't be built on luck, it'll be built on these secrets. And now, so can yours.